Okay, let's look at depreciation and the disposal of non-current assets. And last time I did define what non-current assets are. I think you should be aware this time around what non-current assets are. Those are the assets that the business is intending to keep for a period more than 1 year. Yeah, and we know that those assets, their value, decreases. They lose value with passage of time. Now, the value that those assets lose is what we call depreciation. So by definition, we can say depreciation is an estimate, okay? We can say it's an estimate of the loss in value of a non-current asset over its expected working life. So the estimation of the loss in value of a non-current asset over its expected working life. So it is just an estimation. Actually, it does not imply a cash flow. So cash is not moving. The cash is not going anywhere. So it's not really, it does not imply that cash is flowing either out or, of the business. So it's just an estimation. Those we call them the notional costs. You just keep them in the mind that there is such a cost that exists or such an expense, but it does not imply the flow of cash. That I just wanted to quickly make mention.
Okay.
So now, it is very important that you notice that there are several causes of this same depreciation, okay? And the following are the four main causes of depreciation. Number one, physical deterioration, right? Physical deterioration. And this is actually as a result of the wear or tear due to the normal usage of the non-current asset. It can also be because of the asset, maybe it has fallen down into some poor physical state due to rust, road decay, among others. So that can cause depreciation, the loss in value of the non-current asset. The other cause would be economic reasons. Now, with the economic reasons, you and I may be aware that the non-current assets may become inadequate as it can no longer meet, the needs of the business. It can also become it can also be just because the non-current asset has become obsolete as newer and more efficient assets are now available. So when you have the non-current asset becoming obsolete, it means that it's more like useless. You can no longer use it. It's no longer useful to the business. You no longer need it. And for that reason, we can say that the non-current asset has, deteriorated or has lost value, has depreciated. The other cause could be the passage of time, yeah? So it arises when a non-current asset, for example, let's say a lease has a fixed life of a certain number of years. So, because the non-current asset has got a set number of years, for example, a lease, you've got an operating lease. You can say this lease shall, be in operation for a period of time, let's say for 10 years. So after 10 years, then the lease is no longer working. So that, has stopped becoming useful to you. So you no longer count it. Yeah, the number of years that were set from the very beginning have passed. And that could be one of the causes of depreciation. Okay. Then maybe the last one, but not the least, yeah, of course, when you go and consult from literature, you may realize that there are still many other causes of depreciation, but the few are the ones that I've given you. Depletion is one of them. Yeah, it arises in connection with the non-current assets, such as maybe the wells, and mines. The worth of the asset reduces as value is taken from the asset. So that's about depletion. So these are mainly the common causes of depreciation. Now, are there any methods that are used to calculate for depreciation? Right? Do we have any methods that are used to calculate depreciation? I've already said that it's an estimate, but how do you estimate? How do you calculate? Okay, so the following are the factors that you have to consider before a depreciation method is selected. Number one is how long is the asset expected to last, and how much will the asset be sold for when it is put out of use. Okay, so how much will be the scrap value of the asset, or maybe let's call it the residual value, as it may be called. It is also called the the resale value of the asset. So how much is it going to, how much value will be in the asset at the time when you'll be selling it, and how can the benefits from the use of the asset be measured? So these are mainly the factors that we consider when we are calculating for depreciation. And the following are the methods now that we use to estimate. There is what we call the straight line method, the reducing balance method, and the valuation method, three of them. So,
Okay.
of course, when you consult from literature again, you may find that there could be other methods, but these are the main ones that we have in in accounting, or in the meantime. They are the most prominent, actually. They are the most outstanding. Okay, let's have the straight line method. And before we go any further and look at the straight line method, do you have any questions?
Mm, no, not really.
No, you don't have any questions. Okay, right. So let's have the straight line method. The straight line method is also called the fixed installment method, right? That's the other name. You may still call it the fixed installment method. That is the straight line method. And how do you calculate now for the same? Okay, this is the formula that we use. So it is the cost, okay, the cost of the assets, cost of the assets, and all that divided by the number of expected years of use. Okay, the
Okay.
number, yeah, the number of expected years of use. So when you just divide the cost, that's the cost that you incurred when acquiring the asset. How much did you put in terms of money? And then you divide, by the number of the expected years of use of that particular asset. That is how you calculate for depreciation. That's the first way of doing it. And then this same method, you can still express it in percentages as well for each year. Let me just show you an example. Shall do better, it worse. The financial year ends on 30th of June. On 1st July 20, let's say maybe 23, she purchased the fixtures costing $25,000 and paid by check. She estimated that she would be able to use the fixtures for 4 years, right? So the expected number of years of use is 4 years, and the cost of the non-current asset in question, being the fixtures, is $25,000. So you are to calculate the annual depreciation charge as an amount, of course. So first of all, we said that you have to calculate the costs divided by what? The expected number of years,
Yes.
isn't it?
Yes.
So we are told that the cost of the fixtures being $25,000 to be divided by 4 years, being the expected number of years of use of the same asset, and that gives you 600 $6,250 as the what? As the depreciation for that year, or
Yes.
for each year. So each year, the asset is losing the value of $6,250. Then you can still express this very depreciation using as a percentage. So the cost is 6,250 divided by the cost itself, 25,000, to be multiplied by 100%. Okay, this is the depreciation that we calculated. Then you just divide it by the cost and multiply by 100. That gives you the percentage that the asset has been losing every year. Okay, in terms of the percentages. Is that clear? Because that
Yes.
gives you as 25%. So this is very important and you need to pay attention to it. So significant. But you may be interested in learning that sometimes these assets may have the residual value, right? They may have the resale value, okay, or the scrap value as it may be called in other literature. So you deduct the value, the resale value from the cost of asset, and then divide by the number of expected years of use. That will give you depreciation. So that is in the case where you have the resale value. You're told the cost of the asset, and you're also told that this very asset can still be resold at this value, right? Let's have an example, and this is just an advancement of the previous example. So riding on the previous example, we just add that the sale will be able to be sold at $3,000. Okay. Picking it up from the previous example, we are going to resell the asset at the value $3,000, right? So
Yes.
let's calculate for depreciation. So it is as simple as ABC. Just put the costs, $25,000, less the scrap value being 3,000, and percent divide by the expected number of years of use being 4 years, and that gives you depreciation. If you want to express the same as the percentage, you can put depreciation that you're going to find now divided by the cost and multiplied by what? By 100. Is that fair?
Yes.
Okay. So basically, this is how it is done. And I should be quick to indicate that oftentimes you may not be given to calculate this in amounts. You may be given the percentages. Let's say the asset is said to depreciate at the cost, let's say by 25%. So if it's straight line method, you just multiply the 25% times the cost of the asset. Yeah, the cost of the assets. Now, when you remove the resale value from that asset, that difference, if you have the resale value, is the one that you use to multiply. So you say 25%. Let's say 25% times 25,000. Okay, so the same one is the one that you actually use. Okay.
Okay.
All right. So let's have this example. So this one, the cost was $25,000, right? 25,000 less $3,000 divided by the 4 years. So that gives us 5,500. Yeah.
Yes.
Yeah. So this 5,500, you divide it by the cost being 25,000, and then multiply by what? By 100 to express it as a percentage. So it gives you 22%. Yeah. So sometimes you may just be given the percentages like this one, 22%, that an asset is depreciating at the rate of 22% using the straight line method. So just get this same percentage, 22% multiplied by by the difference in cost, like this difference that you have found, it will still give you the same amount. Okay. Do you have any questions?
No.
You don't have any questions?
No.
Okay, let's proceed. So the second method that we use is the reducing balance method. So the reducing balance method is also called the diminishing balance method. Okay. So in case you come in an exam, you find the question asking you to use the diminishing balance method, it is still the same. It's the reducing balance method. Don't say that the teacher did not, say anything about this. Okay, let's have the same. So what happens under the reducing balance method? So just as the name implies, the amount of depreciation reduces each year. Okay, that's under the diminishing balance method. The amount of depreciation reduces each year. So the same percentage rate is applied, but it is calculated on a different value each year. So what you do is that, let's say you have an asset that is expected to be there for 4 years. Okay. So you calculate for the first year, you count the depreciation that you have, and then you're going to deduct depreciation for that very year. Then what remains, the value that remains, when you say cost minus what? Minus depreciation
Yeah.
is called the net book value, okay? The net book value. Cost minus depreciation is the net book value. In the
Okay.
times when you have the resale value, okay, you can also deduct the resale value. You can say costs minus the resale value or the scrap value minus again the depreciation for that year. What remains is called the net book value. An
Okay.
example will do better. Let's have an example to just mean the same. Um, The question reads, on 1st of July 2023, she purchased the fixtures costing 25,000 and paid by check. She estimated that she would be able to use the fixtures for 4 years and then be able to sell them for $3,000. Now, calculate the depreciation for each of the 4 years, okay? You have to calculate for depreciation for each of the 4 years, and the percentage is what? 40% per annum, like 40% per year, okay?
Okay.
So how do you do this one? See what we do, okay? So the first thing that you do, you write the costs, the cost of this non-current asset was 25,000, isn't it? It was
Yes.
25,000. Then for the first year, we don't have depreciation yet, so we cannot have the net book value. You get because for you to get the net book value, you have to deduct depreciation. Now, this is the first year when you buy an asset, so you have not yet calculated for depreciation. So in this case, this same cost shall be equal to your net book value. So you just multiply the 40%. Just take the 40% of the same cost. Okay, so say 40% of 25,000, right? So what is the 40% of 25,000?
25,000. Mm,
What is 10% of 25,000? Okay, so it is $10,000. Okay, it is
Yes.
$10,000. So you say 25 for you to find the net book value that I'm talking about now. The net book value, the value that remains for the next year. You just deduct that, and it being 15,000 in this case. So this is the book value that remains, the net book value. Okay, so you're going to deduct the 10,000 from what? From the costs. This 10,000 is depreciation. Okay.
Okay.
So depreciation that you've calculated from the cost. So the value of the asset now has remained as what? 15,000, not as 25. No, it is now 15,000. Okay.
Okay.
The value is 15,000 now. So again, you need to calculate for depreciation in this other year. This is more like the new year, next year. So you get 15,000 multiplied by what? By 40%. 40% of the 15,000 now, the net book value. So
Okay.
what's the 40% of the same?
40% going to be
Okay, so it will be 60,000. Yes, so you deduct again the 60,000 from what? From that. So the net book value again that will remain in the next year,
going to
is
be
what?
9,000. 9,000.
9,000. Then again, you calculate again 40% of 9,000, it will give you this. You
600.
deduct that in the net book value will be that. So you do that for each year. You get the point. Each year it's
Yes.
changing. So to go to 2026 again, take 40% of the same, it gives you that. And again, it's like the last year, the following year, the net book value what? 3,200 what? And 40. So basically, this is what happens. Okay.
Okay.
Yeah. So in short, when you're using the reducing balance method, the first thing that you have to identify is the cumulative depreciation from the previous period. Then the cost of the asset minus the accumulative depreciation, like all the depreciation from the time the asset was bought. Deduct all the depreciation. Then what remains is the net book what? The net book value. Then from the net book value, then it's the one that you multiply with the what? The percent that you have been given. You get the
Yes.
point, right?
Yes.
Then with the straight line method, you just get the same cost. Cost times what? The percent given. So that's how different they are. Here you deal with the net book value. You don't deal with the cost. Okay. Now, let's have evaluation method. What about it? So it is actually used when there is no practical, or it is actually difficult to keep detailed records of certain types of non-current assets. Okay, so when it is not practical and it's difficult to keep detailed records of the certain types of non-current assets. So if detailed records are not available, then the previous two methods of depreciation cannot be calculated. So small items of equipment used in offices, let's say, and laboratories, the parking cases, those tools, among others, they are usually depreciated using the revaluation method, okay? Because there are no detailed records that are kept for these assets. So the assets are valued at the end of each financial year, and this is very important for you to learn that the assets are revalued, or they are valued at the end of the year, and that's why the value of assets go in the balance sheet, okay, or the statement of financial position. So you do that at the end of the year, because what we are interested in is to learn that, okay, now the year has come to an end. How much value of assets do we have? So it is prudent for you to deduct depreciation so that you can have an accurate value of the assets that you have, and thereby having the correct net worth. Is that right? Are you okay?
Yes.
Okay. Now, about the revaluation method, we can quickly have this good example to us. So it's the same example that we have now. Let's assume that after some years, they do the revaluation and find that the value of the fixtures has decreased from where it was. It was 25,000. It is now become 20,000 and what? 20,500. Okay. So how can you calculate for depreciation? So you just get the cost at which you bought the assets minus the revaluation value after some time. Okay, that will give you the value that has been lost, which is depreciation. So in this case, we had $25,000 less $20,500. And the value we have is $4,500 as depreciation. Is that okay? Are you okay?
Yes. Yes.
Okay. Now, all these things that I was just talking about, I was just trying to lay a foundation for you. When you come, I may not, you may not never meet a person say calculate for depreciation, really.
Yes.
So what you should be, what you should pay attention to now this time around is to learn how to record depreciation in the ledgers, okay, in the accounts now. How do we record depreciation in our accounts? That is what is very important, okay? Of course, you may not be able to record without you knowing how to calculate. So just know that you knowing how to calculate does not, mean everything. You have to know that there is still more to that. So the asset account always has a debit balance, and this is very important for you to learn. The asset account always has a debit balance, and the provision for depreciation always has a credit balance. Okay.
Okay.
The reason as to why we are crediting the provision for depreciation account is that, depreciation is an expense. That is what we learned in the profit and loss account. Yeah,
Yes.
it is an expense. So all expenses are debited. That's what we said. So what you do, since you have to complete the double entry principle, you have to make sure that when you credit the other account, in this question being the provision for depreciation, you have to debit the other account. That will be the profit and loss account. So that's why you are recording like that. So when you credit the account, you're showing that we have lost the value. So whenever you give out the value, you credit the account that is giving out. And in this case, the account for the provision for depreciation is giving out, right? So you credit the account. After crediting the account, then you debit the other corresponding account. In the question, the corresponding account being the profit and loss account. Is that right?
Yes.
Okay. Now, when the asset is purchased, what happens? When the asset is purchased, you debit the asset account and you credit the cash account because you use the cash to purchase that. And at the end of the year, what do you do? At the end of the year, you have to debit the income statement and credit the provisions for depreciation. Why do you debit the income statement? It's because depreciation is debited in the income statement as an expense and credited in the provisions for what? For depreciation accounts as well. So this is important for you to learn.
Okay.
Now, this time around, let's have the accounts. How do you record? I've already indicated that you debit the assets account, right? Whenever you acquire the non-current assets, you have to debit the assets account. So the asset in question is the fixtures. So you debit the account. So in this case, you've seen the fixtures account has been debited with the 25,000 being the cost of the asset. So you debit the account and the details being the bank because the business used the check to buy the asset. Okay, that's why we put the bank. If it used cash, you could have put cash here. That is about the non-current asset account. And this is just fixtures. It's just one of the non-current assets. So you may have other non-current assets, such as maybe the equipment, just other non-motor vehicles. The way of writing is the same. This does not just mean that this applies only to the fixtures account. No, it applies to all non-current assets, all of them. You record like that. Then what about the provision for depreciation now? So with the provision for depreciation, you have to calculate for depreciation. Calculate for depreciation that occurred in the first year. So if you remember when we were using the reducing balance method, when we use the reducing balance method, we calculated for depreciation being 10,000. Remember, it was 10,000 that we calculated. So what you do is that you credit the what? you credit the account for the provision for depreciation. It has been credited, right?
Okay.
Then you balance off the account. You balance off the account by summing both sides, and then you take the balance carried down being 10,000. You balance the account each year. Why do you balance the account each year? Because we calculate for depreciation each year. So it is not prudent for you to just put all these years together and make one account. No, this is not one account. Actually, if you want, you can be creating for each year, for 2024, for 2025, for each year. Okay. So now we have the balance brought down from the previous period of depreciation. We bring down the balance for the provision for depreciation. Okay. Now, this balance that you have brought down from the previous period, um, you write it on the credit, obviously on the credit side. And then you calculate again for depreciation for the other year. So
Okay.
we calculated that the depreciation for the other year for 2025 was 60,000 for that
Yes.
year. So just that depreciation, only the depreciation is what you record, the 6,000. Then you balance off the account again by adding both sides. So here we have 10,000 plus 6,000. We have 16,000. You record the 16,000 both sides. You have the balance carried down here. You bring it down. And the date that you write when you bring it down, it will be the first day of the new year. Okay.
Okay.
Remember, this is the financial year that you're dealing with. It doesn't
Yes.
mean that it will always have to be January. This business, the financial year ends in June, on 30th of June. So which means 1st of July is the new year, like the very first day. So you record the new year, 1st July 2026, the following year. This is the balance that they have brought down for the provision for depreciation.
Okay.
Then again, you go to the other year, you calculate for depreciation using the reducing balance method. In this question, it was the reducing balance method, but it is treated in the same way, even if you use the straight line method. You treat it in the same way. You get only the depreciation for that year, and then you balance off the account just like that. And you bring it down just like that. Then you calculate for depreciation for the other year, for the next year, only the depreciation, then you balance off the account. So you can keep on doing that, even if there are 10 years in the question or 20 years, whatever number of years you have. Most of the times, they'll just give you a few years, usually maximum 5. But I'm just leaving the mind open. Just be open-minded to learn that you may have many years, but the way of doing it is just basically the same. Okay?
Yes.
All right. If you have learned how to record in the provision for depreciation account, I'm happy with that now. But let me show you how to record in the uh, motor vehicles account. Let's say you acquire a motor vehicles account. Whenever you acquire a non-current asset, please, you debit the non-current assets account, okay? But when you sell the non-current asset, you deduct it. You have to credit the what? Credit the account to show that you no longer have that asset. But you have to pay attention to the dates, just like that. Okay?
Yes.
Maybe now the thing that you should be interested in is how to record disposal of non-current assets. Remember, you have to dispose the non-current assets. You have to sell them. Okay. Now, when you
Yes.
sell the non-current assets, how do you actually record? I think that should be the thing that you should be interested in. So, number one, of course, you start with the non-current assets account. You record in the same way. I said you debit it, and then you balance it off with the amount that you are disposing or that you are selling it. Okay,
Yes.
so let's have the provision for depreciation. You remember now we have got the total balance for the provision for depreciation. Okay, the total balance for the provision for depreciation, and we have the total amount uh, that we have at which you have sold the asset. Okay, so
Okay.
the provision for depreciation at the beginning of the year was what? it was the one that you brought down from the previous period. Remember, you were bringing down all the provision for depreciation, and there was that total depreciation. This is the one that you write. It was brought down from the previous period, and this is the other. This is 2027.
Okay.
You record it on the other side, and then there is the disposal value, the amount at which you have sold this asset. Okay, you
Okay.
record it on the other side, and then you balance off the account.
Okay.
So how do you dispose the fixed, the non-current asset? So you start with, this is their disposal account. And in case you find that person, this is how you go about it. You start with the fixed, not with the fixtures, the non-current asset. You debit the account. The disposal account is debited with the non-current asset. You debit it, then you credit it with you credit it with the provision for what? For depreciation, that total depreciation that you got from the previous period. Then you record the amount at which you sold it. The amount, this is the amount at which you sold it. And then when you balance it off, this is the difference that you find. Okay, the 140. Now, this is the 140 that you find. So you have to check this 140, the disposal amount, goes to the income statement. It goes to the income statement. If it's a gain, it goes where? It goes under other incomes. So you record, you credit the account, the income statement. But if it's a loss, you debit the income statement. Remember, we debit the losses, we debit the expenses. So you debit the income statement just like that. So basically, this is what is there. You can keep on following through. I'll share the recording, and I'll also share the notes with you.
Okay.